part 2 of the updates for the entries and exit. In this module, we're going to be speaking about another type of entry and exit that I like to use when I'm trading, and we're going to be speaking about some exceptions to the rules of the counter trend line break. Okay, now the reason I brought GBP USD forth, this pair in front of you is actually GBP USD. So I did my analysis. If I go on the weekly time frame, so I saw a very similar setup on GBP USD that we saw on AUD USD that we just spoke about in the first segment of this module. So typical left shoulder, right shoulder, head, and obviously, as you can see, a clear break. Just like what happened in AUD USD, we were expecting the market to pull back, okay, into this region and then collapse, and then obviously we're going to come on the 4-hour time frame to execute the trade. Okay, as you can see, on the 4-hour time frame, we have come to put our counter trend line. So as you can see now, guys, this is exactly where counter trend line, drawing them on the wicks, will save you a shitload of money. It used to happen to me before because I was very impatient when it came to stuff like that. I wanted to get into the trade. So the setup looked very familiar with AUD USD, head and shoulder pattern. We've broken the neckline. It was time for us to start selling. I had seen all this room and all this space to the downside, but I told everybody, I said, listen, what I'm going to wait out for is we need to pull back into this. Guys, when the market starts to consolidate, don't avoid drawing counter trend lines like this. Avoid drawing them like this. Be patient. If you are lucky enough, you see 2 outer wicks, join the most outermost ones. Join them. Join them. Join them. This market is very dangerous. Join the most outermost ones. That will protect you. I like to look at my counter trend lines as helmets when you're out in the war, right? When you're out in the battlefield, your helmet will protect your brain from getting blown out, right? So it's the same thing with trading forex as well. So join them properly. So the plan was very simple for this trade. The plan was for us to wait for a bounce off of this, like it happened on AUD USD, and then we're supposed to come and break down, and for us to start selling, and then we'll make all this juicy profit. But however, look at what happened. The market just started carried all the way up to the upside, and the trade call was never fulfilled. So in this situation, this trade was null and void. But if you had drawn this thing too close, you would have sold here, and then your stop losses would have been here, and like, oh my god, and you would have stopped it. And guys, I know the worst period in any trader's life is when your stop losses are here and then the market is trading very close to it, and you wait. And usually this bullish engulfing stop loss candles always happen early in the morning. So by the time you check your phone in the morning, your trade is gone, your account is down, and in the morning is when your emotions are the most vulnerable. You're angry, you get on the chart, you start clicking buttons. Now you are at the mercy of the London session, most volatile session. And then you start to, oh my god, this, that, and then what happens? Okay, this market is in to be. You want to go up, you want shit, right? You want to go up, right? And then you buy, and the market starts coming down, and you're like, shit, this thing was actually want to do, and then you sell, and it starts going up, and then you just mess yourself up. Whereas if you had just drawn the damn thing properly, you wouldn't have even been in the trade in the first place. Okay, so that's one of the things I wanted to speak about in this one. Some exceptions to the rules. So I've spoken about AUD USD. There's another trade that happened way back. So GBP USD. So guys, I can't seem to find any setup for a particular trade strategy that I want to explain to you. Watch out for double bottoms, take some pips. I've spoken about counter trend lines. I've spoken about pullback into demand zones. After the breakout, always wait for a pullback into demand zones. Wait for a bounce. Let the market bounce and tell you. Let it bounce and push it and break the counter trend line. Because this is what protects you. This guy is the reason why this market isn't falling lower. And as you can see, I'm very certain that GBP USD will eventually come lower, because I can see something forming at the top right about here. We've already put in a lower high, lower low, right about lower low. This is obviously looking like a lower high from these previous ones, and I can see a trend line form like so. So I'm just going to be watching it. Okay, I'm going to wait for GBP/USD to play around here. Sometimes, you know, allow the market play around, and then once we come and break down below here, I'll be looking for sell opportunities, or we can rally all the way to the upside. But at this time, for now, GBP/USD is patience for now. Two things can happen here, here, and if we come down here, we don't just start selling here. Scale to 4-hour time frame. Allow the market to do something like this. Okay, let it commit. Allow for that pullback to occur. Join your counter trend lines properly, like we would have done here. Draw a nice one here, and then as the market wants, don't sell inside here. Wait for the break and bleed it to the downside. Or this market can want to come down here. If we form a strong base, okay, form a very strong base, allow it bounce. You see, that bounce is what will save you from a lot of premature entries. Let it bounce and break that counter trend line, and then you're pretty much good to go. So that's exactly how you trade this. Let me see if a couple of things I haven't gone over. I have one more thing I want to speak about. S&P 500. AUD/USD spoken about, GBP/USD break-even trade, rules of engagement, fake out and stop loss hunts, fourth retracement concept, we've spoken about that. Third touch of the trend line always does the trick, we've spoken about that. And that's why I feel like GBP/USD will most likely collapse, because as you can see, first touch of the trend line, second touch, third one most likely collapse. But I'm not God, I'm not the market, I can't really say. I would only trade what I feel or what I think is going on. I'll only trade what I see. I'm not going to trade what I feel or think. The market needs to confirm to me. Okay, now the second strategy that I want to speak about is the range breakout. Okay, the range breakout strategy. Okay, now let us go over to Euro/USD. I think we had a range breakout trade sometime in the past. Let's look at GBP/USD. Now, before GBP/USD got to this point, I remember I was calling GBP/USD at this point for many months. If you're doubting me, check my YouTube channel. But I want to use this as an example. Okay, inside one of these trades, inside one of these movements to the upside, I had found a very nice trade, a pullback trade. I think the pullback trade was this one. Okay, I'm not going to come on the 4-hour time frame here, but I want you guys, I'm trying to use this to explain something to you guys. Okay, I had gotten in on a pullback trade about here. This was a pullback trade. So if you come on the 4-hour, you'll obviously be able to see the pullback properly. So my pullback trade was this one. Okay, was this one. I was expecting this market to catapult from here. You know, we traders, we don't envisage all this sideways movement before we take it. We just think once we get into the trading market, just good. So got into the trade a bit early, about here, because the daily candles are not showing the wicks properly. So 4-hour close about here, and then look at what happened, guys. We get to the 100% retracement, which is the top about here, where I always tell you guys, take out 50% of your position. We get here, and then what I'm trying to explain here is what happens if you get into a trade and then we get to the 100% retracement, and then we take out 50% of our position, and then the market pulls back and stops us out for break even. Don't forget, first trade, let's say we have 2 lots. Buy 2 lots here. The market comes here. We must close 1 lot, leaving 1 lot open. That remaining one lot, we must move the stop losses from that remaining one lot to break even. And as you can see, this market pulled back and stopped us out for break even. We've held 50%, we've closed one lot, we have something in our pocket, but that remaining trade got closed out for break even. How do we, but we still feel like this market wants to go higher. How do we then enter this trade again? Do we draw another counter trend line? What is this? I realized that I didn't explain it properly in the previous videos. So what I do is I do what they call boxing. What does boxing mean? Simple. I just put the damn thing inside a range, inside a box. The whole thing, I just box it. Like so. I just box it like this. So what this really helps me do is something very simple, right? What this helps me do is actually something very simple. So I would put these things in a box, meaning that for the fact that we pushed higher, we pulled back, and we are unable to pull higher again, means that this is a double top. And what really is a double top? After a double top, the market is, that's it. Double tops are ranges. We push, pull back, push, can't break that ceiling, and we come down. We're officially in a range. So I put the damn thing in a box. Now, my strategy now changes to something different. My strategy now becomes range breakout. I'll take that again. If you get into a trade and you stick to your rules, and you're only able to get as far as the point whereby it hits the 100% retracement, you take out 50%, but at that point the market reverses and stops you out for break even, but you still feel like the market still wants to head in that direction, don't start buying immediately or don't start selling immediately. Put it in a range. Cover the top of the double top or double bottom, where whatever happened. Let's say the thing went up, pulled back, and it stopped at the 100% retracement. Put a line there. At the bottom, put a line there, box it, and say to yourself, uncle, when you are ready to move in either direction, you need to come out of the box, right? Good. So it seems like you're not serious at this point. So I'm going to wait for you. I'm going to wait for you to break out of this range in the direction that I feel you're going to go. Then I'll get into the trade. But for now, it seems you're playing the sideways game, so I'll wait for you. So all I did was, around this period, I pretty much sat on my hands. I was seeing a lot of fake outs. You're probably wondering, sir, at what point do you get into a range? At what point do you get into a range breakout? Ideally, what I like to do is I like to see at least two green candles close outside of the range. So if I draw this properly, something like so. Okay, so for these ones, I was watching them. At this point, I was very tempted to get into this market. Now I'm speaking about the pros and cons of this so that you can prepare yourself. You see, in trading, everything is not always black and white. A lot of these guys will tell you they have their strategy in quote and this and that, and they say follow the rules, stick to the rules. Sometimes the rules, sometimes the market is not scientific. This is human psychology happening in this game. So for the fact that it's not scientific, there are always going to be gray areas. And it's those gray areas that you need to understand how to maneuver through those gray areas. So luckily for me, in this case, I was watching this market. I still wasn't sure. We were tapping the top, tapping the top, tapping the top, tapping the top. In all honesty, I got in at this green bar about here. But in hindsight, this would have been your entry. Now, where do your stop losses go for a strategy like this? Your stop losses, now the reason this is the downside to range breakouts is your stop losses must come in the lower third of this of the box. So my stop losses, even when I got into this trade, my stop losses were here. Okay, first third, this is the first third, second third, lower third of the box. Okay, how do you measure it? Simply calculate the length of this box. If this is a 100 pips box, put this at 80 pips. So in this case, my stop losses were at 80 pips. Still the same thing anyways, even if I had gotten here, the only difference is I would have had to stomach all this up and down. Ugh. But your stop losses must come at the lower third of this box. This box is really, really helpful because it stops you from being greedy. Why? Now you don't feel so bad when the market doesn't go all the way in your direction, because now you know that you have another strategy that you can use, worst case scenario, to get into this market. And as you can see, the market eventually rallied all the way to my target at the top hand side. So sometimes you hear me state that once I don't care whatever the market does at the 100% retracement, I don't care even if the market gets there and turns around, as long as I've banked something. The reason why I can confidently state that is because I have this strategy to use to get in again, if indeed, because I'm saying to myself, if you can't break the 100%. Now, guys, what does 100% retracement mean? Let me explain that to you guys. 100% retracement simply means this is top. So we pull back, we push. This is a 100% retracement. I said if we can't break here, it's dangerous for my trade is open. So I'd rather take something, move my stop loss to break even, and protect myself, and wait for you, and box you, and watch you. If you did eventually break out of the box, then I can get in again. But if, I don't know, do what you want to do, but I'm going to box you and then wait for you. But I'm never in a hurry. If I get into trade, the market doesn't just go in my direction once and for all, I'm okay. I'll take what the market gives me and wait for it. Because sometimes, let me tell you a lot of something. Sometimes, guys, the market just isn't ready. Sometimes what the market just is not ready, and there's nothing you can do about it. Sometimes the market just isn't ready. Okay, let me see if I was looking at the S&P 500 a couple of days ago. Not much. I've already explained the concept for why I got into the S&P 500. It was simple: trend line bounce, support bounce, bullish engulfing daily candle bounce, entries here, stop losses here, and I've ridden all this wave all the way to the upside. So the strategy is pretty much the same. I like to wait for bounces off of key levels and then daily candle close. But for S&P 500, I noticed that the S&P 500 does not usually give us room to draw the counter trend line. But one thing I know about the S&P 500 is you don't really need a counter trend line to jump into the trade. The market will respect that level. It will respect that as long as you get your key levels right. Daily candlestick pattern entries. Good. I knew I was forgetting something. So this was the coronavirus spike to the downside. Everybody was shouting on the news, the world is coming to an end, the world is coming to an end, the world this, the world that, world this, world that, the world is ending. I just simply came on here and I looked left, I drew my trend lines, and it was so simple and straightforward. All that was happening was that the market was pulling back into key levels. When the market dropped, I simply waited. I said, well, how I will know for a fact if the world is actually coming to an end is if we break this level, then I'm going to be scared. Then the world is coming to an end. But we literally have a key level that this market can come into and bounce out of. So I was watching. We broke it, but look, we stayed here. I was watching it. I didn't get in at this green candle. I watched the market. I was watching. We moved left as we pushed all the way to the upside. I said, this is it. But although my stop losses were very wide for this trade, I'm going to be very honest, but because I knew the upside benefit for this trade, I didn't mind. It was a long-term play, and stuff like that. So guys, all the strategies that I've showed you guys here is two very basic strategies: counter trend line and range breakout, and candlestick pattern. Once I see candlestick patterns form, left, give me a base, right, right again, we are going. I'll take it again. Pull back, base, base, bullish engulfing, we're going. That's all I need. I'm not going to buy here. Although you say, if I bought here, I'd have made more money. This market could have bled all the way to down. Calm down. At this point, you are angry. Calm down, relax. As you're happy again to go higher, I will follow you to the promised land. So that's exactly what this strategy is about. Now, guys, all these strategies, like I said, you can use them on lower time frames, 15 minutes, 10 minutes, whatever time frame it is you're trading. All I'm doing here is structure, okay, market structure, and that's how I like to get into this trade. So do yourself a favor, guys, go ahead and comb my entire YouTube channel. Try and watch from module 1, from Trader Talk to module N, and then I want you guys to see how I use these entries and exits in real time. All of this will really start to make sense to you guys, okay? What else? I think that's pretty much it. Range breakout strategy, spoken about that. Fourth retracement concept, fake outs and stop loss hunts. Rules of engagement have been spoken about. When to get out of a trade, I told you. Daily candle exits. I didn't speak about exits properly. Shoot. Now, usually for my exit, what I like to do is something very simple. If I come to AUD, so what I like to do for exit is something very simple. I like to use what I like to call the 127 extension. That's exactly what I like to use. So for instance, if I draw my Fibonacci from this swing high to swing low, I would use, this is why I was so hell-bent on 0.700 being my overall target for this trade, because this is my 0. It lines up with the key level. So all things being equal, my overall targets were here for 2 reasons. This blue bar and the 0.27 extension. Ladies and gentlemen, when you're done with this, go back and watch the module on Fibonacci retracement. Okay, I speak about exits. Also watch the exits video again. You see me use the 0.27 extension as well. Guys, Fibonacci is one of the most powerful tools in this game. All these entries that I made on this AUD/USD were all Fibonacci plays. A, B, C, D. Okay, A, B, C, D. A, B, C. Obviously, this broke lower than D, but if I draw this properly, I'm swing high, swing low. You can go with me or not. A, B, C, D completes here. What? Third touch, don't forget this was the third retracement, always even gives you more pips than the 0.27 extension. So first level target, guys, my first level target is always the 100% retracement. Second level targets will be the 0.27 extension. Third level target would then be my overall target. I'll take it again. First level target, 100% retracement. Second level target, the 0.27 extension. Just draw your Fibonacci from swing high to swing low. You see the orange bar at the bottom. If you haven't gotten your Fibonacci sorted out properly, check the module on Trading View like a pro. I teach you guys how to do it properly. And then even Bitcoin. Let's quickly do something on Bitcoin. Let me tell you why I feel Bitcoin is going to make record highs at. See Bitcoin, Fibonacci. This is how I'm able to predict thousands. This is how I'm able to predict a madness in the market, and people think I'm a wizard. This is so simple. Fibonacci high. This is impulse leg pullback on high time frames. When you do them on higher time frames, you can see further, and then you can come to lower time frames and trade in that direction. So, as you can see, if Bitcoin can take out 65K, which is his previous highs, which is this one. For people that are holding Bitcoin, this level is very significant. You guys better start praying to your God that it breaks this level. If it breaks this level, then we're clear all the way to the upside. So if I took swing So A, B, C, and I can tell you for a fact that if Bitcoin breaks 65K, next level target will be $80,000 per coin. Why? Because of the Fibonacci extension. Now, what is even this Fibonacci extension about? It is a very basic concept that states that impulse leg will always be equal to resultant legs. Well, almost similar. So if I clone this, that's what it means. Impulse leg will be equal to result. So A to B, C to D. If indeed this market wants to come and form a higher high, it will come and form a higher high and give you the same amount of wavelength that the impulse leg gave you. See guys, I'm giving you guys a lot of free info, a lot of information for the price of literally nothing. Most of you guys didn't really pay much for that, for this course. So let me keep some of my information back to myself. Anyways guys, you heard it here first. If Bitcoin breaks 65K, next level target will be $80,000. Ladies and gentlemen, I have been able to do justice to this topic. I hope I have. You can feel free to use this on lower time frames, but ensure that when you're trading on lower time frames, ensure that you're trading in the direction of the trend. Everything always boils down to direction of the trend. I'll show you how I get in, why I get out, at what point I get out, and stuff like that. So if for any reason you guys want me to cite more examples, I usually like to update this course every quarter. I will most likely be updating it as I have more trades and I've placed more trades. The reason I use this trade examples was because these were my most recent trades that I placed. So yeah, that's pretty much it. Once again, thank you guys for staying till the very end to part 2. Trying to make sure I've gone through everything. Watch out for double bottoms. Always ensure that the market pulls back into that key region. Wait for the bounce of the key region and the break of the counter trend line before you get into the trade. Always take some pips at the 100% retracement. When do you get out? Watch the daily candle. If you see a bullish engulfing candle on the daily time frame, get ready to get out. 127 extension, get ready to get out. Third retracement is always the best one. First one, you can watch out for it. The fourth one, don't take the fourth one. If not, you lose 75K like I just did. Don't worry, 75K is only 3% of my entire account. No, it didn't bother me that much. What else? Yeah. Don't forget, if for any reason you get into a trade and then the market gets to the 100% retracement and you've taken out a certain portion of your trade, you've done what you're supposed to do, and the market is still acting like he's not sure if he wants to go up or go down, put it in a range, box it, keep it there. Tell it when you're ready, you will let me know. Ladies and gentlemen, thank you for staying to the very end of these 2 very lengthy modules, updates of entries and exits. I'll catch you guys in, obviously, on my YouTube channel, whereby I keep updating you guys once again. So ladies and gentlemen, thank you for staying to the very end. Once again, it's yours truly, Dapo Willis. Now I can go for a swim, take it easy, and